Understanding options on stocks, put options. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our Facebook page and our email and our phone number. We spent some time on the prior two videos talking about call options. Now we're going to talk about puts, but the beginning of the story is the same. There are risks and rewards to owning common stock. The good news is stock prices can increase an unlimited amount. The risk is that stock prices can go to zero. So in order to limit risk, and the reason for buying a put option is the ability to, quote, lock in a sale price for a stock in exchange for paying a premium. The best example I've come up with is car insurance. Let's assume Joe is a car owner. The worst case scenario for Joe's car is that it's totaled, it's worth zero. And so what Joe needs to do is to lock in a sales value, that is, a value that he can sell his car that is now totaled. This illustration is a bit of a stretch, harder to illustrate put options and call options. So he goes to State Farm, who's an insurer. And State Farm, using an actuary, calculates the likelihood that Joe will total his car. And based on that likelihood, they will calculate a premium payment schedule to insure Joe's car. And what we're trying to say is that there's a contract between the car owner and the insurance company. Joe, our car owner, pays a fee in the form of insurance premiums for the right in bold to sell the car for a given amount if the car is totaled in an accident. State Farm, the insurer, receives a fee in the form of insurance premiums, and they are obligated to buy the car for a given amount if the car is totaled in an accident. So to recap, Joe pays a fee for the right to do something. State Farm receives a fee and is obligated to do something. And Joe, our car owner, controls the transaction. He can do one of two things. He can pay the premium and keep the insurance in place, and by that he has a locked-in sale price for the car if it's totaled. He can stop paying premiums, cancel the insurance, and his risk is that if the car gets totaled, he'll get nothing. And another issue that we'll see down the road is he must own the car to have something to sell, which sounds odd, but we're going to see that down the road. So let's talk about a put option buyer, a similar scenario that we had for call options. So my example is our stock is IBM. We buy an option that expires in May that gives us the right to sell the stock at $50 a share. That's what we mean by a 50 put option. We have the right to sell if we own a put. So the buyer pays a fee for the right to make a decision, like we saw in the prior slide, in this case the right to sell a stock at a specific price for a specific time. And what I say in the last bullet point is the buyer of the put has the right to sell 100 shares of IBM common stock at $50 a share anytime between now and the end of May. That's what the put option buyer has. The seller, the other side of the transaction, receives a fee and is obligated to do something. The put option seller is obligated to buy 100 shares of IBM common stock, one contract, at $50 a share at any time between now and the end of May, and in bold we have, in italics we have, if the buyer chooses. The buyer back here controls the transaction. The seller who receives the premium is obligated and does not have control of the transaction. If we flip over to Excel, here's an example. One contract, which means we control 100 shares. The common stock is IBM. The month the contract expires is May. The strike or exercise price is $50 a share, which is why it's a 50 put option. At 3, and since one contract controls 100 shares, a premium price of 3 means the premium in terms of dollars is $300. So let's think about maximum gain, loss, and break even. So our put option buyer is going to pay a premium of $300. And what he is betting on is that the stock price moves below $50 a share. Ideally, he would exercise by selling the 100 shares at 50 and buying them at $0 a share. 0 would be perfect for the put option buyer, because if we take the exercise price of 50 less a cost basis of 0 less the premium that we paid of 300, we're going to have a maximum gain in this case of $4,700. Again, exercise price of 50, the cost of the shares 0 in a perfect world. That would give us a profit of $50 a share, or $5,000, and if we subtract the $300 premium, there's our maximum gain. The most we can lose for buying an option, whether it's a put or a call, is the premium that we pay. We pay a premium, we don't exercise the option because the stock moves above $50 a share. Why would we sell it at 50 if the market price was at 75? We wouldn't do that. The maximum loss is our premium. So where do we break even? Well, really, break even is explained up here. We paid a premium of $300. If we exercise and sell at $50 a share, but the shares cost us $47 a share, we're going to break even. We take the exercise price of 50, that's dollars in the door, less our stock's cost basis of 47. We're left with a $300 profit. We subtract off our premium payment, and we end up with 0, which is our break even. What about that put option seller? Generally, if you sell an option, your maximum gain is your premium. You hope the other side doesn't exercise the option. You receive your premium of $300, the buyer doesn't exercise the option because, as we set up here, the stock price moves above $50 a share. Buyer doesn't exercise, put option seller pockets the premium. The most we can lose, you'll notice that there's some symmetry here. The most we can lose as the put option seller is the same as the most we can gain for the put option buyer. Same calculation. Because the seller must buy the stock at the market. So, exercise price of 50, we're forced to pay 50 for the shares, buy them at 50. If the stock price goes to 0, that means we've lost $50 a share, and if we subtract the premium that we got, we have a loss of $4,700. And finally, on break even, the break even for the put option seller is the same as the break even for the put option buyer, just put a different way. In this case, we're going to have to buy the shares and pay out $50 at the exercise price. If we went out and bought the shares at 47, and then we also subtract from that total the premium $3 or 300, we would end up at break even of 0. So you'll notice that there's a symmetry. Put option buyer's maximum gain, seller's maximum loss, $4,700. Buyer's maximum loss, the premiums, is the seller's maximum gain, the premium, and the break even is the same for both sides. The break even is the same. There will always be a symmetry between the put option buyer and seller. That's the end of part 3. You'll find our hour-long essential courses online. We are also starting to produce continuing education courses for CPAs and lawyers. Our YouTube channel, Ken Boyd STL, all one word. Our website has a complete list of our videos for one-on-one tutoring and live chat sessions. Here's our website, our email, and our phone number. Thanks very much, and we'll see you next time.